Curious about the ways to make money in the stock market? Do you know how much passive income $100,000 would generate? Investing in stocks could be complex, but we've got you covered. Welcome to 5-Star Finance. It all depends on 3 variables: time, monthly contributions, and the rate of return. $100,000 invested in the stock market is a great way to kick off your stock market career if you're younger. But how much money can you expect to receive from this much capital? Would it be enough for your bills, car payments, and your mortgage payments? Perhaps it can provide you with the essential peace of mind when you'll see the cash stacking up in your bank account without having to work. We've all heard that the earlier we start to invest, the easier the financial freedom game gets. But just how much easier can it actually get? Time and rate of return matter a great deal to the investor. We all know that sufficient time and a higher rate of return can make an investor successful. Let's break it down. Let's assume that our goal is to accumulate $100,000 by the age of 65. Then the question that arises is how much we're saving per month. A 40-year-old that starts investing and generates a return of 4% per year, in order to stack $100,000 by age 65, he needs to contribute about $195 per month. If his investment journey gets rough and his monthly contribution varies, maybe he'll earn 2% per year. In that case, he'll need to contribute $257 per month. On the other hand, if he was successful and the return rate goes up to 6% per year, he might have to contribute $144 per month. So far, we've seen that the rate of return has a certain impact on how much we need to start to save per month in order to achieve our goal. But let's look at someone who is 20 years old and steps into the market. If the rate of return is 4%, he'll only have to pay a rough estimate of $66. And if he's earning 2% a year, the monthly contribution jumps to $114. But what if he earns 6% per year? The monthly contribution decreases to $36 per month. Now, if the person is older, let's say 50 years old, the monthly contribution goes up significantly. This explains how time, monthly contribution, and the rate of return can vary. To put the long story short, the younger you start, the easier your journey gets. And the higher your rate of return, the sooner you will achieve your goal. Ways to make money in the stock market: stock price appreciation and dividend. It goes without saying that the amount of money you'll generate depends on where your money is parked in the market. You could invest in the general broad market index fund, or you could also buy individual stocks to maximize growth and income, or could purchase a mixture of both. Dividend yields will vary based on the price you paid for the stocks in your portfolio. You don't want to be invested in solely income investments way before your projected financial freedom date, simply because overall returns are lower with dividend-paying stocks. This is because they're not fast-growing companies, but rather older blue-chip companies fighting for their survival in the market. No doubt a higher income is nice to have, but it is ultimately irrelevant for younger investors. If you invest your entire capital worth $100,000 in a firm which is on the brighter side, you can expect growth and income combined, which is a huge success in the early stages of your career. Your income depends highly on the performance of the company. Currently, the S&P 500 yields a dividend amounting to 1.5%. This means you will receive a profit of $1,500 per year or $125 per month. The overall revenue you generate might not be ideal, but the growth rate amounts to 10%, which is more than ideal for most of the young investors. To put the long story short, buying S&P 500 index funds and earning through dividends can be the go-to approach for all the people starting off with the stock market. In order to be successful in the stock market, understanding the compound interest is very important. Understanding the compound interest. So, what exactly is the compound interest, and how can investors benefit from it? In investment, you either have simple interest or compound interest. To put it simply, compound interest means that you earn interest on interest, while the simple interest sticks with the basic principle. Let's understand this with an example. If you've invested $10,000, you can earn a stable 8% per year. That means you will get $800 in simple interest every single year. Year 1 or year 20, you will get those $800. Now, compound interest, on the other hand, allows you to earn interest on interest. If you invested the same $10,000 in a company that offers compound interest, your interest will gradually grow from $800 from year 1 to $1,100 in year 5, and so on. If your shares were worth $30,000 in simple interest, they are now worth more than $60,000. If you want to earn through compound interest, then the best possible way is to give yourself more time and stay patient. It's not about how much money you're investing, it's about how much time you're giving your money to grow. So young investors have the biggest advantage. They can allow their money to grow, and that is what leads to compound interest. One way to earn through compound interest is to put money back in the bank and let it grow. But it is not going to be productive in the long term. If you think you're going to become a millionaire by simply putting your money in the bank, you're wrong. So the best way to earn through compound interest is to invest your money and then let your money grow over time. Tracking your progress is essential while earning through compound interest. You can't just invest and forget about it while hoping you will achieve the results you hope to. The stock market is the best place to earn through compound interest because it provides you with a return rate of 8 to 10%, which increases your chances to double your capital. How did Warren Buffett do it? Price versus value. To put it all in a nutshell, price is what you pay and value is what you get. Both price and value are two sides of the same coin. Understanding the difference between price and value is the core principle of value investing. The stock market today is riddled with examples of success, but one thing which is common among the top players of the stock market is their understanding of value investing. How did they pull it off? Knowing or having the ability to predict the intrinsic value of a stock is pertinent to having long-term success in the market. Value investors don't get busy with the short-term return rates, but the value of a stock after crucial years is what they live for. Understanding and analyzing stocks depends largely on the price and value of a stock. Price of a stock can vary, depending on the changes in the trends of the market. If people want to get their hands on a stock, the value of the stock will rise. If less, the value goes down. How to determine the value by analyzing the stocks? While analyzing the stocks, many things should be kept in mind. You must go through your entire calculations. You have to understand the business of the stock you're investing in, analyze the financials, and look at their management before arriving at a suitable conclusion. You also need to analyze whether the company you're investing in has a competitive advantage or not. You don't just blindly invest in any company. Whether you're starting with the calculations, you need three things. Firstly, you need trailing 12-month earnings per share, you need the estimated growth rate, and then you need to know about the future PE. These things are fairly easy to find. While analyzing the value, you need to compare the values of the analyst's expected 5-year annual growth rate and the equity growth rate. You need to pick the more conservative one. After analyzing the equity rate and the growth rate, it all comes down to how well you know and understand the business. To build a stock portfolio, first you need to know which stocks will be picked. There are a total of 6 stock categories, and the way you invest in each one of them can drastically impact your portfolio returns. Get our free ebook in the description below to learn everything about it. Analyzing a stock can be tough, but if thoroughly understood, it could provide you with an upper hand. How do you plan on investing in the coming years? Which of these 3 variables, time, monthly contributions, or rate of return, will you focus on to achieve your goals? Let us know in the comments section below. Check out this video we handpicked for you, and we'll see you in the next one.